Welcome to Spidel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the benefits of health savings accounts, including account portability. Attend Spidel's Federal Tax Update webinar on January 9th and 10th and get the best update to prepare for filing season. See a list of topics covered and get registered at spidel.com under webinars. Most tax professionals understand the general benefits of health savings accounts, or HSAs. The benefits include the fact that employer contributions are received tax-free by the employee, and taxpayers who have not maximized their contributions during the year can make additional contributions by the due date of their income tax return, not including extensions, and claim an above-the-line deduction using Form 8889, similar to contributions made to a traditional IRA after the close of the taxable year. If the taxpayer uses their HSA funds to pay for qualifying medical expenses, then distributions from the HSA are never taxable, and HSA funds are owned by the employee and are not subject to the use it or lose it rules like a flexible spending account, or FSA. HSAs are only available for taxpayers who have a qualified high-deductible health insurance plan. High-deductible health plans carry lower monthly premiums, but the taxpayer has to pay more health care costs themselves before their insurance company starts to pay its share. Taxpayers who are healthy and don't use a great amount of health care services should generally prefer a high-deductible health plan that can be matched with an HSA. They can even use the savings generated from paying lower premiums to fund the HSA. When an employee chooses a qualifying high-deductible health plan, they become eligible to open an HSA at any financial institution that offers them. Employers will often have a financial institution available for employees, but employees generally are not required to use it. One of the great benefits of HSAs is that the money in the HSA account belongs to the employee. Even employer contributions to an HSA are required to be 100% vested immediately. So if an employee remains healthy year over year, their HSA account will continue to grow, assuming the employee makes regular contributions into the account. And, like an IRA, accumulated HSA funds can be invested in stocks, mutual funds, etc. The fact that an employee has complete ownership of their HSA means the account is portable. If an employee doesn't like the financial institution where they have their HSA account, maybe because the fees are too high or the investment options are inadequate, the employee can roll over the funds from one institution to another. When rolling over funds, there are a couple of things to keep in mind. Indirect rollovers are allowed, but the taxpayer is required to deposit the funds into the new HSA within 60 days. Indirect rollovers are reported on Form 8889, line 14B. And if using a direct trustee-to-trustee transfer, the original financial institution will not issue Form 1099-SA to report the transfer. Spidel offers numerous on-demand webinars on a wide range of topics, such as stock incentive plans, solar energy credits, the beneficial ownership information reporting requirement, and more. To see the full list of offerings, go to spidel.com and click Webinars to access the list of on-demand courses. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.